the next sources of finance session we're going to have is on bank loans. Bank loans are when a business borrows a sum of money and pays it back with interest over an agreed period of time. So for example, you could take out a £10,000 loan and you would agree to pay it back in 6 years, and then possibly you could have monthly repayments that you make. It's a long-term source of finance. It's definitely an external source of finance because it's not coming from internal, it's coming from the bank, someone outside your business, and it's commonly used by new and start-up businesses, but it can be used by any businesses. It's more commonly used by new and start-up businesses because they don't have access to retained profits, for example, in order to invest. And that's really what it's about. It's about using bank loans as a source of finance because it's a common tool for expansion of your business. Maybe you have one shop and you want to have two shops. Maybe you have 50 employees, but you want to expand in order to have 55 employees. It's a classic way to expand your business. The pros of bank loans. So number one, well, you're not giving up any share in your business. It's not a form of equity, it's a form of debt, and it's a form of long-term debt. So no share needs to be given up, therefore you're going to keep control of your business. Number two is that it's likely to have a lower interest rate than an overdraft, which is another form of debt, except overdrafts are a short-term form of debt. It's likely, in terms of a bank loan, to have a lower form of interest and therefore lower costs. Thirdly, you can make your bank loans custom-made, bespoke to your business. So you can agree the repayment terms that make sense for your business and the predicted profitability of your business in the future. So you can decide in your repayment terms how long you're going to need to repay the loan back in, and also when you will repay it. It could be the first of the month, the second of the month, or the third of the month, whatever makes sense for you and your business. Next is number four, and number four is that, look, if you make frequent or always make repayments, well, then it might improve your credit rating. So if you take out a bank loan and you always make those repayments back, then it could improve your credit rating, which could enable you to get further sources of finance in terms of long-term debt in the future. And fifth is that, well, because bank loans are a long-term source of finance, they're going to go onto your statement of financial position, your balance sheet, and therefore they're going to increase your net assets. And if they increase your net assets, therefore they increase the net worth of your business. In terms of the cons of bank loans, well, number one is that, look, assets are going to be taken from you. If you fail to pay your bank loan repayments back, you could lose your assets. So it's particularly poignant if you have limited liability. It's good to have limited liability if you're going to take out a bank loan, because otherwise you're exposing yourself to possibly unnecessary risk. And number two is that there's no flexibility to bank loans because you must keep to the repayment terms that you agreed at the start of the loan. Thirdly is that if you fail to make your payments back for the bank loan, then it's going to worsen your credit score. That could limit the amount of sources of finance that you get in the future, so it's something to be careful with. And finally is that if you take out a bank loan, well, then you're going to increase the gearing of your business because you're taking on more long-term debt. I hope that helps with bank loans, and I'll see you at the next Sources of Finance video.